Dave Reeves, Managing Director at Calidus Resources. Calidus Resources is a gold producer in the Pilbara of Western Australia. Currently, annualised production of around 70 to 75,000 ounces per annum, building over the next few years to 130,000 ounces per annum.
Dave, good to see you. Thanks for coming back on Swing in February for a quick catch-up. But big news in terms of announcements this week, and we'll find out exactly what it means. So let's start with the quarterly report. Give us the headline numbers.
Yeah, quarterly report. It's our first ever quarterly report because we hadn't declared commercial production to 1 January. So good quarter, 15,200 ounces sold. Produced, 16,000 ounces sold. All-in sustaining cost Aussie 2,093 versus revenue at 2,509 Aussie an ounce, so a gross margin of about $416 an ounce, which means we made about $5 million of operating cash flow for the quarter.
Right. Okay. When we talked, you were talking the game of going from 70 to 130,000 ounces. You told me that you're going to have to raise some capital to allow you to do that expansion. You have raised some money, but it comes in the form of equity. Why?
Yeah, good question, Matthew. So we looked at all sorts of different forms of debt, royalties, what have you. And obviously it's a hugely sensitive issue, dilution, especially for our current shareholders, myself included as second largest. And at this price, it's just as an analyst keeps telling me, there's deep value here, Dave. It's ridiculous. I'm like, sure. But I think the market was never going to let the brakes off the share price until we had that rectified. Now, when we did all the numbers on the royalties versus equity, we looked at it from an NPV per share, and royalties were probably a little better at that point. But as soon as you extend mine life beyond what you model, royalties are there forever. So you're always taking a haircut. But probably the biggest single factor was risk. For instance, say a royalty. If you look at a royalty, it's taking a margin off your operating cash flow. So you're paying 2.5-3% royalty per quarter. So for this one, that would have been 450 ounces, which is, sort of, let's call it $1.4 million coming out of that cash flow. That's actually quite a chunk. And where we are as a company at the moment, we're in our highest strip ratio areas. So it's our lowest margin areas. We only start increasing that margin next year. So if the gold price starts coming down, that margin suddenly gets very compacted very quickly, and that's a significant portion of it. So a lot of it's to do with risk, to make sure that we get through to the end of the year in a really good position with our working cap to fund expansions going through. Because if we got our margin squeezed in the interim, that puts us back to where we are now, and we just can't go through that again.
I mean, you took a very kind of cautious language here. And help me understand why that's important to you. Obviously, you kind of got your hedging in place. You're talking about, well, what if gold drops down? I mean, most CEOs are talking about gold at $2,500 US bucks. And obviously, you've kind of got this kind of debt facility that you're paying down. I mean, you paid down a bit more than normally this quarter as well. So why is the caution important now and not in the future, and into the future, things will be better? I mean, how does that relationship work?
Yeah, so look, a lot of the commentary, and we certainly think that gold has got a really bright future ahead of it, but it is a very volatile world and market we live in, and I don't think any of us saw the uptick in the gold price in the recent couple of months. It had just been sort of flatlining, what's going to change, and suddenly it's up and it could be back down again tomorrow. And we just, for this next 9 months, that is incredibly important to us, and we are long-term believers in the gold price. But for the next 9 months, we want to minimize all risks, focus on operations, paying down debt, making cash, and getting ready for the expansion, and not worry about, oh my goodness, maybe we need to go to the market for more funding, because our margins being pinched.
Right, and so this is a function of the geology, the high strip ratio now, or for the rest of this year, to release the potential into in the future. But could you come at it a different way? Would it have made sense to look at the project, look at the ore body in a different way, and maybe high grade it initially? I mean, was that an option?
Not really. The ore body is pretty consistent, and how you mine it, you can't separate the high grade portions and whatnot. So we did obviously have a good look at that. And I should point out, on the royalty front and things like that as well, I think the royalty companies use consensus gold pricing, which is back at $1,700 US. And that consensus pricing needs to catch up. So they make their returns and it makes more sense to the mining companies. And we're in that point where as gold prices go up, what they're offering you is not following immediately. And so there's a bit of lag in that, and that would close over time. So I'm certainly not saying royalties are never, but just for our unique position where we are today and where the gold royalty companies and their gold prices are, it's something to bear in mind.
Right, and the other big point that you were very keen for me to go away understanding last time when we spoke was obviously if you can increase the throughput, you'll decrease the cost because you'll be taking out more ounces, and that was a big part of this. This was like we are going to do an expansion phase now, and we're going to need money to do that. So with the 23 million bucks Aussie that you've raised, plus the cash which you're generating, and the capital which you've already got on the balance sheet, what does this expansion look like? Because 16,000 ounces is fine, but you're talking a much bigger game to me. So what does that look like? What does that growth profile look like? How do you get it?
Yeah, for sure. So it's firstly bed down what we've got and make sure we're getting that 18,000 ounces, maybe up to 20,000 ounces a quarter. And then we've got the underground beneath the open pit. So 10 to 15 million of capital see us down there. And that brings in 2 gram material versus the 0.85 that we're feeding at the moment. That's more ounces. We're just displacing lower grade ore with higher grade ore. More ounces, same all-in sustaining cost of, let's say, the $1,750 an ounce, which is our longer term open pit cost. But more ounces, same margin, means more cash. So, and, less percentage influenced by the hedge. So, it's a double whammy to get those extra ounces.
So that's the goal. But you do have the hedge, you do have debt that you continue to pay down. And I guess what shareholders are going to be looking at is, well, when do you get into kind of steady run rate? You've done that ramp up, you've optimized, and then you start throwing off the cash. What time frame are we looking at before the kind of good news starts arriving?
Look, each quarter is building on the last. This quarter we're in should be better than what we've just been in. But it's really the second half of this year where everything will be done. Airport will be operational, thickener project complete. So many things complete that the second half of the year will certainly be better than the first half. We're doing a whole life of mine recut at the moment, working out some new designs for the underground. Where do we get portal positions off, etc. When do we bring in blue spec versus the underground? Because blue spec's not just blue spec; it's a new float plant, but it's also a high grade little open pit near us. So there's a whole range of components that we need to fit together, and somewhere around our annual report when we've got to recut all our resources, that's when we'll announce a new life of mine plan with all those metrics and timing.
Right. Okay. So with all the capital, are you saying that all the kind of capital components are now paid for and embedded, and it's just a case of working out what the kind of OPEX run rate is now? I'm trying to work out how much will you need to raise more money. That's the simple question.
No, definitely not. So, that's what this raising's all about, was to give us the working capital and show people that we've got the money in the bank to fund these expansions now. The operation's throwing off cash now, so that will fund the debt, and what we've got in the bank will fund the kickoffs on these projects. And as they come in, they obviously generate more and more cash, become more and more self-funding. So it's just working out which one we do first, why, from practicalities, permitting, you name it. We've got all those pieces of the puzzle to to work through. But no, the whole idea on the raising is to say, look, we've got plenty to do these expansions and we are making money. You can see that in that quarterly, and we'll only make more and more money each quarter going forward. So in a very good position to where we were 4-5 months ago.
Right. Okay. So you built a mine. It's operational. So that's kudos to you. Very few people kind of get there. You do have a few things in the background. You mentioned one of them, blue spec. It would be quite easy to go and blow your brains out and raise a lot of money, kind of ramp up super quick. So can you give me a sense of how you're viewing the timing and the allocation of capital to, deliver 130,000 ounces? Have you got an end date in mind, or are you very conscious of the economy and, making sure you don't do anything too ambitious?
Yeah, look, the plan we'll put forward, and look, I wish I could answer that in more detail, but until we've recut this life of mine, I'd be using old data, and it would be misleading for both of us. So, the blue spec takes a couple of years to get up to full production, whereas the underground, it's more like 18 months. Having said that, the underground and blue spec, both of them ramp up during that phase. So it's an incremental growth, let's call it over the next 2.5 years to that 130,000 ounces.
So obviously underground looks more attractive by 6 months, so not much in it, but you're going to have to fund that out of cash flow. So in terms of, I guess, building a cash reserve and getting to that kind of free cash flow position, what are we looking at in terms of timing there? Because there's a danger with all production companies that they kind of keep plowing the money back in the ground, and there's not much left for, well, whether it be acquisitions, or giving monies back to the shareholders, or what all those sort of lovely things that people invest in companies to see.
Yeah, look, all valid points, but I think the more ounces we're doing at a similar all-in sustaining, the more cash we're throwing off. Your overheads are spread over more ounces, all those sorts of things. So it makes sense to put the money back in the ground for that reason, and it fully utilises the infrastructure. So how do we ensure we don't blow ourselves up while we do our proper planning? We are looking at reducing costs at blue spec from stated capital in a couple of ways. We're looking at a different style of plant, or really just, if you like, one sourced out of China that's fit for purpose. It's only a small plant. We think we can shave quite a bit of money off the cost we used, which was a first principles Aussie-built plant. Then we've got things like access to a nearby camp that's suddenly become available. Maybe we don't need to build a camp. Doesn't sound much, but we allowed $6 million for that. So all these capital, areas we're looking at whittling down, and the lower we can get them, the earlier we can start the project. So that's something we're looking at now. We've been working on a permitting. Now we've got this funding solution in place. We can finalise our life of mine, finalise our cash flows, and then decide when to best start each of those projects.
Okay, so I know you're spending a big chunk on the development activities, but with regards to the exploration and upside, obviously you want to be chasing higher grade. You spent nearly $1 million this quarter. What are you focused on?
So we're doing a lot of exploration at what we call Felix, which is a new discovery along strike from blue spec. Some pretty nice numbers came out of some first pass drilling there. So we need to do more work down there. We're still quite a way off a resource, but there were some decent widths and grades. We will start to, as we're becoming more familiar with the geology at our main Warrawoona pit called Klondike, we will start to move out to the east and west and down dip from there, because that's the low-hanging fruit of adding mine life to us, is immediately beneath the pit and along strike. So we'll do some more there. But again, it will be just a very steady spend on the exploration side.
Okay, so you're currently like 100 million Aussie market cap, right? And the shares, I think, like most precious metals, has been sort of a bit battered and bruised in the last 12 months or longer. What do you think traditionally has worked in terms of messaging into the market? And have you noticed perhaps new signals that companies are needing to put out to the market for shareholders to give you a bit more time, as it were, or for potential shareholders to come into the story. You talk about brokers going, this is undervalued, effectively, what they're saying. There's real value. If you're a contrarian thinker, you might be wanting to look at, Calidus Resources. But you've also got to do your job and signal to the market, we are good news because what? What's the message?
Well, I think we're good news because we're through the commissioning issues that we had, we're making cash. That's the single biggest difference. There was a lot of uncertainty, and rightly so, around where we were heading. Believe we're mainly through that. A couple of quarters of solid performance will definitely put that to bed. And, certainly the gold stocks in Australia have seen quite an uptick in the last couple of months, and we've generally missed out on that. And I think that's a lot of the overhang on our balance sheet. So that's now removed. So it's really out there when I'm talking with some of the new shareholders that have come in, for instance, in this raise, and some of our existing ones, they say, we love it. You're through the ramp-up issues. We see cash coming out. We see where you're heading. We see that you've now got the funds, and it's just a matter of time. So that's, it is quite a simple message. Now it's about fine-tuning timings and putting numbers out there so people can understand fully how we're going to get to that 130,000 ounces.
Okay, what are we going to be talking about next when I see you?
Next, when we talk in a few months' time, we should be pretty close to demerging the lithium out. We've finally pushed the button on that. We've got a bit of spare time. We're not just living and breathing the daily production at the mine. So independent geologists is off writing their reports. Prospectus is underway. So that'll be there. We'll be just talking about hopefully another improved quarter of production and cash flow. We'll be talking about where we're heading with our exploration rig. So, lots to talk about, Matthew. Nothing earth-shattering, but just building from the base that we've got now.
Okay. Dave, thanks very much for the update. Glad to hear you got the money away. Now it's a case of getting on and doing something with it. So we'll speak to you soon. Thanks.
Thanks.